OptionChampion.com.
Today is Saturday, October 1st. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications, nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to Tricks of the Trade on this Saturday as we close the books on another week, another month, and another quarter. Friday marked the third straight quarter of losses for the major cash market indices, with the Dow losing more than 6%, the S&P 500 more than 5%, the Nasdaq Composite more than 4%, and the Russell 2000 more than 2.5%. On the economic front, second quarter GDP fell by 0.6% on an annual basis, compared to a decline of 1.6% in the previous quarter, and in line with expectations. The latest decrease marks the second consecutive quarter of negative GDP, indicating that the U.S. economy has entered a recession. Core PCE, which measures the price of goods and services purchased by consumers, excluding food and energy, increased by 0.6% month over month, above the forecast increase of 0.5%, and above the revised flat reading in the prior month. And weekly unemployment claims came in at 193,000, down 16,000 from the revised reading of 209,000 in the prior week, and beating the estimate of 215,000. The latest economic data rattled investors, sending the major cash market indices deep into negative territory for the week, with the Dow losing nearly 865 points, closing below the 29,000 level for the first time since 2020. The S&P 500 lost 104 on the week, the Nasdaq Composite lost 282, the Russell lost 15, and volatility gained $1.70. Crude oil finished the week higher by 31 cents, gold gained $16.60, silver gained 18 cents, and natural gas lost 18 cents on the week. And here is a graphic showing the performance of the major market averages for the week, month of September, third quarter, and year to date, and as you can see, they are red across the board. Today we're going to look at a couple of losing positions from the portfolio and whether or not it is worth it to roll. More specifically, we're going to look at two short put vertical spreads where the short legs are in the money and decide whether or not to roll those legs down to a lower strike. The first runner-up is Block, symbol SQ. I have on a $10 wide short put vertical spread where I am short the 60 put and long the 50 put, both in the November monthly cycle with 48 days until expiration. As of market close on Friday, the underlying stock price was $54.99, putting the 60 strike in the money by $5.01. Because the underlying stock price is below the 60 strike by $5.01, that option has $5.01 of intrinsic value for the buyer on the opposite side of this trade. When I sold this put on September 20th, I received a credit of $6.63. Subtracting the $5.01 intrinsic value from that $6.63 credit leaves me with $1.62 in extrinsic value. With the stock price below the 60 strike of the put, the counterparty has the option of exercising the put and selling shares at that $60 strike price, and I would be obligated to acquire shares at $60 even though the stock is priced at $54.99 in the open market. To reduce that risk of assignment, I can roll my short position down to a lower strike. The strike closest to the stock price is 55, so let's look at a scenario where I roll down from 60 to 55 and manage that leg. I received a credit of $6.63 when I sold the put at the 60 strike, and to buy it back, I would have to pay $9.40, which of course would result in a loss. And then I would receive a credit of $6.58 from selling a new put at the 55 strike in the same November expiration cycle. Now let's assume that the trade goes in my favor and I take 50% of the $6.58 credit as profit, which would be $3.29. Add all those figures together and I would have a net profit of 52 cents on the short leg of the vertical spread. But remember from the previous graphic that I have $1.62 in extrinsic value left on my 60 strike. If I were to roll down to the 55 strike, I would be giving up that $1.62 for a potential profit of 52 cents. The 55 strike is selling at $6.58, but my existing 60 strike gave me $6.63, which is a difference of only a nickel. So it's not worth it to roll. I'm just going to keep what I have. Suncor Energy, however, is a different story. If you recall from 2 episodes back, this is the combo position where I had a long stock position with a long put vertical spread as a hedge. I was long a 32 put and short a 31 put, both in the October expiration cycle, and I closed the 32 put for a profit, leaving the short 31 put open. But since then, at 29 days until expiration, the stock price fell below the short 31 strike. So I rolled that October 31 put down to the 30 strike in the November cycle to gain time and to reduce my risk of assignment. Later, I added a long 23 put as downside protection. So now, in addition to the long stock, I have a $7 wide short put vertical spread where I'm short the 30 put and long the 23 put. Let's ignore the long stock leg for a moment and examine the short put vertical spread. As of Friday's close with 48 days until expiration, the stock was priced at $28.15, putting the 30 strike in the money by $1.85. This poses a potential problem. When I sold the 30 put, I received a credit of $1.85. Subtracting the $1.85 intrinsic value from my $1.85 credit leaves me with no extrinsic value on that leg of the spread. I am definitely at risk of assignment. With 48 days until expiration, I'm probably safe, but still, I don't want to take the chance. So what if I rolled that 30 put down to the at-the-money strike of 28? When I opened the 30 put, I received a credit of $1.85, and to close it, I would have to pay $3.20, which, added together, would result in a debit of $1.35. There's a double asterisk there because we're going to reference that $1.35 debit in a moment. Selling a new put at the 28 strike would give me a credit of $2.08, and 50% of that as profit would be $1.04. Add the figures together and I would have a net loss of 31 cents on that leg of the spread. Because I also have a long put at the 23 strike, selling a 28 put on top of it would still make this a short put vertical spread. I had paid 70 cents to buy the 23 put, so deducting that from $2.08 would leave me with a $1.38 credit on the spread. Let's again assume that I take 50% of the credit as profit. In this case, 50% of $1.38 would be 69 cents. Adding that into the $1.35 debit paid to close the 30 put and the roll would reduce that debit, or net loss, to 66 cents on the spread. In last week's episode, I mentioned that I had a conditional order to buy another 100 shares of Suncor Energy at $31.75 to achieve a specific average price per share. With the stock currently priced at $28.15, I have canceled that order and will focus my attention on the short put vertical spread, hopefully closing that spread soon and managing the stock position separately when it rallies back up into the 30s. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.